What up, HyperChange? Welcome to another episode. This week's Sunday Scheme In. Today we're going to start off with Tesla's impact report. It's the 2020 impact report, which makes it sound a little late, right? But not. This is the most cutting edge stuff. Every year, or for the past couple years, Tesla has released this what's so-called impact report. Sort of when you think about typical ESG, environmental and social governance, this big buzzword that gets thrown around for companies, it's not just about our profit, it's not just about our people, but it's about the impact we're having on the planet and how our company, everything from our products to our factories, what is the total emissions of that, and how are we thinking about reducing that from sort of systems level approach. So super important trend, and I think this is a huge trend in finance that the world has been waking up to this ESG movement. But Tesla, not only do their products sort of take us into the electric age and create this amazing technology to make us go green and sustainable, but they're also leading the charge in the reporting and sort of the documentation of their entire company's ESG initiatives and go way above and beyond. And so for the past couple of years, they've been putting out this incredible PDF report, which documents all of the stuff they're doing, literally like the water usage of their factories per vehicle, the total emissions from, producing the car, the emissions of while using the car, depending on whether you're burning, coal or solar powered of your car, how much emissions is it for a rideshare vehicle. So literally going through every step of the process. And this is a 94-page document this year that I just got my hands on yesterday, so I haven't had time to go through it. We're gonna go talk about a couple of the highlights, but I'm gonna put a link below. I mean, this is incredibly well done. Tesla tripled down on this project this year and put even more work and thought into it. And I think it's really, really interesting. I'll just read a couple of the starting lines so you can get a flavor for it. The objective of an environmental, social, and governance ESG impact report is to disclose the impact a company has on these areas, as well as to present, to the extent possible, data and other information qualifying and quantifying that impact. At Tesla, we strive to be the best on every metric relevant to our mission, to accelerate the world's transition to sustainable energy. In order to maximize our impact, we plan to continue increasing our production volumes and accessibility of our products. In more concrete terms, and this is actually where it's like, damn, they're dropping some real clues here. In more concrete terms, this means that by 2030, we're planning to sell 20 million electric vehicles per year compared to 0.5 million in 2020. So the next decade, they want a 40x increase in production, which we know is kind of the thing, but if you're holding Tesla, think about this as an amazing growth stock, it's like, wow, these are the numbers that should get you excited. 20 million cars a year make them like one of the world's largest, if not the world's largest auto manufacturer. There's about 100 million cars sold a year, so if Tesla sells 20 million, that's 20% of this new annual global fleet that Tesla would own. That's 20% of this global market share, assuming no growth. So that's kind of the pie in the sky number. If you're thinking about Tesla as the stock or the company, the backbone of this bull valuation that takes us to several $1 trillion, maybe even without autonomy, just by selling these vehicles, is the 20 million number. And so it's insane, and I love that they put that in there. Also, and this is another good clue, as well as deploy 1,500 gigawatt hours of energy storage per year compared to 3 gigawatt hours in 2020. So that would be even more than a 40x increase. That's like 500x increase in the amount of energy storage deployed. So, when Tesla and Elon Musk continue to reiterate that the energy storage business and batteries are going to grow much faster than vehicles, they're putting that in here too. So incredibly detailed report. They have this front page that goes through some of the highlights here. I just want to highlight this because I still get messages and DMs on Twitter about do you know that if your Tesla's using coal, it's actually going to be worse for the environment, and this is why we shouldn't, do Teslas. And they're like young people that are sending me this message, and I'm like, oh my God, I can't believe there's still so many misconceptions that electric vehicles, even if they're charged with the current status quo of the grid and your grid is heavily reliant on fossil fuels, are still way better than the status quo. And then that is victim to the #1 rule that is kind of hindering, is just the #1 logic that stops people from thinking about EVs, which is the stagnation fallacy. Random term I invented, but I think it's so important of you can't assume the grid is always going to be fossil fuels because it's stagnating at that mix of this much coal, this much natural gas, this much solar, which even so already makes it better to have an electric car than a normal car. But the new grid mix is changing rapidly towards renewables, and this trend is just accelerating. And if you look at the past estimates of all these official reports, they were way too low. So you've actually seen, and this is really, really good news for the world, despite, all the wildfires and all this crazy stuff is happening, the deployment of wind and solar is rapidly accelerating, and they're the most cheap ways to create new energy. If you're going to create a new project, you are going to want to do it with wind and solar. And even more so exciting is Bitcoin, which people say is, ruining the planet with energy consumption, is actually accelerating the adoption of those renewable energy projects by giving them that unique energy buyer to accelerate the ROI of that solar project to make it easier to finance and get it done. So lots of exciting stuff happening there with the change in grid mix. But they have this really simple chart, and I love how Tesla just boils it down to literally one chart. Average life cycle emissions in the US in grams of CO2 emitted per mile. You can see the average mid-size premium ICE vehicle is at 400 something. And actually, it's worth noting that in the front page of this, they talk about how a lot of this is underreported. Finally, it is important to note that the current ESG evaluation methodologies tend to use a generic template to analyze every manufacturing company's carbon footprint. Vehicle use phase, which realistically accounts for 80 to 90% of total emissions, including in scope 3 of ESG reporting, is repeatedly underreported. If you think about a gas car, this is when they're literally like burning the gas, right, to go. That's the vehicle use emissions, and that's the big misconception of electric vehicles. Like, yeah, it's a little bit more carbon intensive to create the car, but then over the life cycle of the car, you're saving huge amounts of energy during the use phase. And during these ICE cars, you're, it's a little bit less carbon intensive to create because you don't have this huge battery, but then you're constantly refilling oil into that car. And that's where over the life cycle, over that, 10-year ownership or whatever your ownership of the vehicle you have, it's going to be way more polluted, all things considered, to use that gasoline car. I feel like I'm preaching to the choir here. Why am I even saying this? But that is what it is. So, and what I didn't know is, and that's 80 to 90% of those total automotive emissions. As the use phase reporting guidelines remain vague, OEMs often use unrealistic assumptions for lifetime mileage and unrealistic fuel consumption figures rather than real world figures. As a result, it's not uncommon for the carbon footprint of the use phase to be underreported by up to 50%. So I think that it's really interesting, and Tesla goes about how their estimates use real world mileage and real world energy consumption data sourced from our fleet of over 1 million cars on the road to calculate green emissions as savings. We believe that reporting the use phase emissions based on real world fleet data should become an ESG standard. So I think what they're saying here is, even though we look way better than the ICE cars on this chart already, it's actually the gap's even bigger than you would expect because of the ICE vehicles underreporting, so to speak. So the average mid-size premium ICE car versus the Model 3 using the grid charging, as you can see, it's actually, I was even kind of a little off there. The manufacturing phase is almost about the same between the Model 3 and the average mid-size ICE car, just slightly more, you can barely see it. But then over the use of that vehicle, even assuming it's charged from the grid with its current mix, you're looking at, less than 200, so greater than 50%, almost 60% less grams CO2 emitted per mile. So that's over the lifetime of the vehicle, you're gonna emit 1/3 as much of the CO2. So a huge game. So we could even triple the vehicle fleet if they all go electric, and assuming the grid doesn't change, and we'd still be putting out the amount of the same CO2 in the atmosphere. So this is a game-changing, needle-moving. It's not just better in a little bit of ways, but actually better in a huge amount of ways. And they also go on to talk about how eventually the lowest one here on the left looks like around 30, which would be about 1/10 even, or less, maybe 1/15 of the total emissions of the average ICE car of a Model 3 used for ride sharing charged off solar. So this is where the stagnation fallacy comes into play yet again. Like, Tesla's not stopping where they are now. They're constant, not only are they, 3 times as good from grams of CO2 a mile today, but they're planning to get, 15 times as good. So that's an insanely ambitious and awesome goal here, where your Model 3 with ride sharing usage, our cars are empty 90% of the time, 95% of the time. If we can reduce that, because you're renting out, the people who own the cars are renting them out for rides, and you're charging it off solar energy, you're gonna be looking at 15 times less energy usage. So incredible. And we all kind of know this, but I always think it's super important to reiterate, like, let's keep looking at the numbers, let's keep looking at the data to make sure whatever we're trying to tackle this transportation problem with is the best way. And so huge news right there. The other thing I wanted to mention, which is super epic, which makes me feel a lot better as a Tesla owner, is capacity retention of the Tesla batteries averages 90% after 200,000 miles of usage. So that means, and they have this incredible chart, and once again, this is real fleet data, like the integrity of the data that Tesla has, and you could say I'm a fanboy and I'm biased, but I've just over time watched them do this. And then you have like companies like Volkswagen do Dieselgate. I mean, that's ridiculous, right? And talk about lying on your reporting. That's why I don't trust anything like Volkswagen and Porsche do. And it's like, think about the company ethos you'd have to have a coordinated scam like Dieselgate. Like, that just doesn't go away. And it's like, yeah, Volkswagen's pushing with the ID4 and their new charging network, but it's like, to me, there's something really important about your corporate culture and DNA. And Tesla's corporate culture and DNA is like science, engineering, facts, like the truth, and trying to figure out problems from a like first principles approach and doing what's best from the systems level, and kind of honesty, frankly. And I think that's not in the DNA of any other automaker. I mean, look at the way they talk about electric vehicles. Electric vehicles are nothing until Tesla succeeds. Now we're going to do electric vehicles, but then they never come through on their promises. Like, it's just all bullshit. And so I think it's so ironic that the narrative in the media and the Tesla Q is that Tesla is the one not to trust with bullshit claims and reporting, when in reality, that's actually every other automaker. So yeah, I just think that's insane. And anyway, point being here is, that was another big piece of Tesla FUD, is like, wait, like, how fast is the battery going to degrade? I'm going to need to replace my battery every so that, like, you always find that guy at a dinner party who's like, right? Like, who's like, yo, like, I know I've done my research into lithium and you're gonna have to replace that battery. It's gonna cost $10,000, right? Like, this is one of the biggest pieces of Tesla FUD. But actually, and this is why I did an interview a while ago with the guy from Tesla, Raul, this was such a dope interview, because he had operated like the longest mileage. Even though this was like over a year ago, he had already had Teslas with like 400,000 miles of range, right? And so he was already showing that the battery degradation on those was like 85% or 90%, like very little, even over hundreds and hundreds of thousands of miles. That not just the battery not degrading, but the maintenance cost, the drivetrain, all of the parts of the vehicle were holding up incredibly well. And so I actually, with Sean Mitchell in Los Angeles, he rented like this Tesla Model X and drove me around. I think it might have been a Tesla car, but it had like the longest amount, it was like hundreds and hundreds of thousands of miles, but it worked great and it was perfect. So now more and more data is coming out about how incredible Tesla keeps their battery. And this is why, once again, people are going to say, oh, don't buy, you know, look at the Leaf, look at the Rivian, look at the GM. Well, those are very unproven battery technologies for capacity retention over time. And I think Tesla, you know, if I'm going to buy an EV that I want to think about as an investment, like everybody who has a Leaf, like the battery on the Leaf, like sort of degrades like so quickly. And so it's like, I don't know, you know, they have like a third of the range left after a few years. Like, it's barely usable. Like, there's no way you're going on a road trip with that. The range numbers aren't reliable. And yes, Tesla has that problem too. The range degrades, and like they say it's a 300-mile range car. It's really like 200 or 250 depending on how you drive it. But it's even much worse for every other electric vehicle. So I think these numbers from Tesla that show that it hits about 90% capacity retention. So your car with, you know, 300 miles of range, let's say, will still have 270 miles of range after 200,000 miles. And so more and more data is coming out about this. And if you think about the stagnation fallacy here, this is data from Tesla's older fleet of vehicles. And as the new technology gets better, the 2170s that are in my Model Y are probably fire, right? Because they've been making those for a long time. Panasonic's nailing it down. This data with 200,000 cars were the early Teslas. So I think this is only improving. So this is once again bucking a huge FUD trend. And then their upcoming factories will set a new standard for low energy and water usage per vehicle, water withdrawal intensity in vehicle manufacturing in meters cubed per vehicle. Pretty interesting. And as you can see, to have Tesla in 2020, BMW getting major props here, being the only company ahead of Tesla, but Tesla already ahead of the curve. And you have to remember that this is with a factory in Fremont that they took over from GM and Toyota. They didn't build from scratch, so a lot of issues there, and Tesla's team wasn't great at building factories yet. So as the pace of innovation accelerates and Tesla's productizing the factory gets better, their water energy usage per vehicle is going to decrease. And so Gigafactory Texas and then Berlin will have it looks like Berlin is going to be like setting up by far a new standard for water usage per vehicle. Another interesting trend is they talk about how much cumulative energy produced by Tesla solar panels versus consumed by Tesla factories. I love this. So you think about Tesla's systems approach. I mean, they're putting solar, but even though we don't think of their solar business as huge, this chart shows you that even though they're ramping factories and building all these factories around the world, the amount of solar energy that their solar panels are producing, it looks like from this chart, like 5, 6, 10x even, more energy is being produced from their solar panels than is being consumed by their factories. And so that's really awesome too. Another really interesting thing to consider here is the energy efficiency, EPA range in miles per kilowatt. So basically saying like, how big is your pack? How much range are you getting relative to how big your pack is, which is important for a lot of ways. First of all, if your pack is smaller, you get more out of it. You know, we're doing way more with the raw materials and resources there. So it's like, if Tesla can build the same size battery pack as Volkswagen, but you're getting 40% more range, you know, maybe you only need 300 miles range, so they can start building a smaller pack and they could be using less raw materials. So that's a really powerful way to think about the sustainability of the EVs, is how much sort of range and juice are you getting out of all those raw materials that you're putting in the battery. And that is so much goes into that. The aerodynamics of the car, which is something that Tesla is super, I think, doesn't get enough credit about. Like, they have some of the best aerodynamics in the whole automotive industry, and they like set records with this. And that's super important, especially at highway range, for efficiency of the car. And I also think it goes to the technology. Like, when I say like you're buying another electric car, like the technology is just, you're paying more for shittier technology usually. Here's the data in the chart. Like, they're using more raw materials, so it's less sustainable, and they're getting less juice out of it. Like, they're not good at maximizing those raw materials. This is another testament. The Model Y, by far the best in its class. The Model 3, by far the best in its class in terms of raw materials and this energy efficiency. So once again, Tesla, on so many different levels, you're paying for just world-class technology that is second to none with a pretty huge gap. Origin of non-Tesla produced vehicle components in the Model 3 and Y. So, you know, when you think about automakers like GM and Ford and everyone else, they're like this big global supply chain. They're globalizing, you know, they're setting up factories in Mexico to sell our cars in the US. Like, I think that's horrible for our jobs. it just, I think it makes, frankly, them less competitive because their pace of innovation at the manufacturing supply chain level, like every other car company was like outsourcing as much as possible. Like only thing that GM and Ford want to do is literally put their logo on the front, and the MBA I love this, like MBAization of America, and that's what Elon and so many people talk about. It's so true. Like all these, you know, they will do anything like, you know, the MBA, some guy went to Harvard who just like went, you know, Harvard MBA, but he went to dope Ivy League school before that. He's got the perfect resume. They hire him to tell them how to run this auto company. Like he's never worked at an auto company. He's never actually worked at any company or like done anything really besides build spreadsheets and PowerPoints. And then they tell you how to run your company. And this MBAization is like, we're going to outsource this, we're going to outsource that, we're going to outsource there, and make this huge global network of supply chain. Makes it super hard to innovate, super hard to move fast, and is like, I think, worse for your people, worse for the planet. So many different levels. It's just a bad move. And so Tesla's taken, once again, how different are they? The 100% opposite approach in their DNA of we're going to do everything as local as possible. And so vehicle manufacturing in California, North America, of 70, the origin of non-Tesla produced vehicle components in the 3 and Y, as you can see in California, 73% are from North America, others 27%. And then with China, this is so cool about Shanghai and China, there's so many different electronic and component suppliers there. ICE vehicle, noise pollution, right? Yeah. And in Shanghai, it's 86% of local parts. And this is also huge for margin. This is also huge for cash flow because Tesla can get paid for the car before they have to pay suppliers for their parts. And if their suppliers are close, that's huge as well. So I think there's so many, and they can work with the suppliers closely, iterate on the products faster. So a lot of different advantages there of what Tesla's doing. Covering roof space with solar panels. This is just kind of a cool fun fact. Gigafactory Nevada was designed to be covered with solar panels. Today we've installed solar panels to the capacity of 3,200 kilowatts. This installation will grow to about 24,000 kilowatts. The whole roof of the current building structure by the end of next year. This will make it the largest rooftop solar installation in the US. We are installing solar panels at other locations as well. Ooh, okay. Amazing charts here on the Tesla semi-truck. We all know this is coming, but even though the US vehicle fleet, just 1.1% of it is going to be these huge trucks, if you look at the amount of US vehicle emissions, it's 17%. So this is why, and this is when I went to Autonomy Day, I got the chance to like go in the Tesla Semi and kind of like talk to some of the people working on it. So dope. And it was fascinating to hear them be like, look, there's not that many semi-trucks on the road, but the amount of emissions that they have is such a big impact. And so, and I also think another big part of that is road safety, not just because it's dangerous to have these big trucks on the road, and, you know, obviously something that's bigger that's more dangerous for everyone else that's smaller on the road, but it's really hard to pass a truck and trucks passing each other is super hard, especially up hills. Like imagine, you know, when you're on a highway and like there's a 2-lane highway and one truck's trying to pass another truck and it's going so slow and takes like 5 miles, it creates this huge backup, and then you get all these drivers that are super pissed off behind it that are ready to like skirt by and cause like another crash because they're just road rage is building. Like even though semi-trucks are just 1.1% of vehicles, there's 17% of emissions. They're, to me, way outsized, I don't have the number on it, but of safety as well on the road. And so this is an extremely important product for Tesla to commercialize. And you think about their goal of transitioning it, you know, why with Tesla's limited battery cell production, why is the semi-truck so high on the roadmap? This is why, because with a limited amount of cars, they can put a lot of CO2 emissions, reduce CO2 emissions by a huge, huge amount. And so I'm a huge fan of that. And I think it's also kind of like a fun fact and just kind of like F you to the whole industry that the truck, the most powerful thing that is kind of this symbol of the ICE vehicle, you know, towing huge amount of capacity, they can disrupt that and displace that with their own vehicle. I just think that's incredible, honestly, and that's like a testament to how Tesla's been able to be the first real company to create the you know, battery technology and drivetrain technology that's powerful enough to do better than the diesel truck, because that's been the roadblock. Like it's like, you know, electric cars are golf carts. They don't have enough sort of power to be able to get all the needs done for these trucking drivers. And so Tesla's about to change all that, and I think they're going to use that crazy new motor that was in the Plaid Model S, or that's what I'm thinking. I don't know that for sure, but that would be my theory. This incredibly new energy efficient engine that creates the Model S Plaid, the fastest car in the world, that can go like, I think it's like that crazy carbon rotor thing, right? 0 to 60 time less than 2 seconds. That same technology put in the semi-truck, and that's what's so cool about Tesla. Like, you're buying the Plaid, you're subsidizing the development and the early stage limited production of that crazy technology that then they put into other products. I don't know if that'll exactly happen, but that's what they do. And so really stoked on the semi-truck, although I'm still like, where are they going to build the semi-truck? I don't think they've officially said that. I think it's going to be Austin, but yeah. Battery recycling, this is huge. And so this chart kind of says it all. But when I was at Tesla, the Cybertruck event, I had a really interesting conversation, maybe I shouldn't name them, with a Tesla employee about this. And I was like, okay, so what's good with like redwood materials? What's good with, you know, this and that? And basically the gist was that the amount of extraction you can get from recycling a battery, like once we mine, you know, okay, so there's 1 billion cars on the road, that's like all we need, maybe 1.5 billion. Eventually, like we have to mine a certain amount of raw materials for that. But it's not like when you throw away your car, you're throwing that away and you have to remine all those materials. It's actually really a huge amount of those, maybe 85, 90% of what's in that battery can be reused and recycled. And then once we have it, that's why this chart is so dope, we can just start reusing most of the materials. So the amount of mining isn't like massive and growing. We'll have this glut of mining to get enough raw materials out into this battery flywheel so that things can work and we can have enough for the fleet. And then we'll start, as these cars start coming offline, we'll start recycling those batteries. And so I think that's super dope, and we won't need to mine as much. And Tesla's really pushing that. And once again, pushing the pace of innovation, pushing the R&D to be able to make this incredible technology happen and reduce the overall life systems of the vehicle. Like, it's not just like they're cutting every single corner possible to sell you this electric car that's going to screw the planet in the long run. It's like, no, they're thinking about what's going to happen in 20 years when that electric car is done, and how if we're actually going to change the world, we need to make every single car electric and minimize the impact of that production on every single level. Like, it's a systems approach. It's not just the product. And I think Tesla's very unique in that thinking and that ethos. And that is the biggest takeaway from this corporate impact report, is that it's a systems approach. Tesla doesn't just think about the product. They think about every single thing that goes into creating the product, that goes into how that product is going to impact the world we live in. And I think that's super inspiring. And so, okay, I think I've spent enough time on this for now because we've got a bunch of other stuff to cover, but yeah, huge props to Martin, the IR team, and Elon, and just the, you know, the team for putting this out, because this is epic, and this is the kind of stuff that makes me proud to be a shareholder, and why I have, you know, Tesla's my biggest investment. I love the company, like, even more than just, I just love them, like, because it's just, they're setting the bar, not in terms of dopeness. I mean, they are setting the bar in terms of dope products and fast products and sexy products and just bringing us in the future with technology, but they're also setting the bar on doing the right thing. Like, you just can't, there's just no price on that. Like, we really need to get our shit together, hyper-change the world. And if companies are not thinking about, every company needs to be thinking about stuff in a systems approach. And I think Tesla, by putting out this report, pushes the entire industry forward and forces everyone else to do something similar, and forces everyone else to audit themselves at a new standard that they wouldn't have done before. Just another example of how Tesla's changing the world. And so, epic. Tesla has registered 5 new versions of the Model Y for production at the Shanghai factory. And in the last conference call, they said they want to make Shanghai the new vehicle export hub. And we recently got data that in July, I want to confirm this for y'all, out of 33,000 vehicles produced, about 20,000 of them, or over 20,000 of them were made for export. So Tesla, like Apple, right? They outsource everything to Foxconn in China, who builds their things, and then they ship them all around the world. Where Tesla is not, this is why Tesla should be worth more than Apple. Like, they're Apple, they're the brand, they're the tech, and they're the Foxconn, and they're the manufacturer. Think about how much margins they're getting there. And think about Foxconn is like horrible. Like, it's basically like, yeah, I don't want to say, yeah, it's just greasy labor. Like, horrible to work. Like, man, it's like you're in prison if you work at Foxconn. Like, you read the stories. We all know, right? But nobody wants to talk about it. So that's the shit that Apple supports with your iPhone. What does Tesla support? Super dope, forward-thinking tech jobs built by robots in China, and they're getting the margin from that. Like, I feel like, damn, I'm just repeating myself over and over again, but like, Tesla's literally not only doing something that's better for business and profit and shareholders, but also better for the planet here. So on so many different levels. And so, and what they're doing here is incredible, because this is happening a lot faster than I thought. Tesla's exporting so many vehicles. So, you know, the Fremont factory, they didn't get to build that themselves. And so that wasn't their first product. And then especially when you think about the Model 3 line at Fremont, how much did they learn from that? How much failures, you know, it's failures like the key to success, right? And so Tesla, by failing and by trying so hard to get the Model 3 to work in this California factory, selling to the US with the highest cost possible, the highest employee costs, failing, learning how to build this production line, did this incredible job of refining the product, which is the machine that builds the machine, their factory. And so now they put that in Shanghai, this 2.0 Tesla factory, which is why they're building them in Austin and Berlin in 2 seconds, because, and we're going to talk about Berlin in a sec, but, and now it's showing up in the numbers, essentially. And so we have a huge, like, the cost to build the Model Y in China, way cheaper. And maybe just as good of a product. And if you think about, they're exporting it to Europe, where they're used to all these bougie, you know, BMW things, and that's where Tesla's exporting the cars built in China. So this whole thing that like made in China is not as good quality, Tesla's crushing that status quo and that norm. So I mean, this is epic. And this number, like more than double, it sounds like, the cars sold in China, they exported from that factory. And this is something I expect to continue. And this is a clue that why, and I don't know, I tweeted at Elon and be like, yo, what's good with the Model 2 unveil, or like the 25,000 mass market car that they keep talking about that they're going to unveil soon. Like, they have to, right? Because especially rumors are and shout out to Tasmanian, who's been documenting this. And I think they're, shout out to Vincent, he's awesome. One of my buddies, he runs Tasmanian, and he's just been on the ground in China, so ahead of the curve on the news and the gossip and what's good with Tesla there. And they keep reporting that the Model 2, or that's 25,000 mass market cars in development, they're building factory space for it. There could be even prototypes mobbing around of it. And so it's like, damn, like this is going to happen soon. And so you think about how Tesla's turning Shanghai into an export hub now for Model Y. Imagine what they're gonna be able to do with Model 2. So I think what's the next big Tesla factory news to drop is like a tripling of the size of the Shanghai plant to accommodate this Model 2 production for, you know, production initially of 1 million to 3 million units a year for global export. And so I think that's a really big idea. And this is still kind of a guess, because I'm like, will they build all of them in Shanghai? Or is it worth building a portion of the Austin factory or new US factory to build a Model 2 there? This is where Elon has said in the past, it's better to like build vehicles locally as much as possible because the supply chain is shorter. You don't want to ship cars all around the world. But now Tesla's ironically doing that from Shanghai. So in the Model 2, it's cheaper. So maybe, you know, the friction of moving a car that's that size stays the same, even though the ASP drops. So the incentive to export a vehicle that's lower price is lower. So maybe that'll play into it. But I don't know. I think it's really interesting. And in the long run, I wouldn't mind to see Tesla just build everything in China and export it globally if that's what works best for them. And yeah, really interesting to see that going on. Moving on from Tesla news, Airbnb reported another quarter. This is one of my favorite large cap, actually probably my favorite big cap tech stock, although I did sell my Airbnb stock to buy Square because I think Airbnb is a 5x in 10 years and Square, or 5x in 5 years. Square might be a 20x in 5 years. I don't know, depending on how this Bitcoin stuff works out. But yeah, honestly, I'm still torn about it. And this is the problem. Like, I don't have enough money. I want to create this thing, shout out to one of my mentors for this idea of like the HyperChange 5, like the 5 most publicly traded companies that I love, that I kind of support. It's not like an ETF, but it's kind of like if I was going to make an ETF, this is what it would be. And instead of making an ETF, I'll just give it away for free on the internet. And so that's kind of my scheme. And one of them, Airbnb, Square, Spotify, Tesla, obviously. And there was one more, I think Peloton, but I don't know, I need to think about the last one. But Square, Airbnb, Spotify, Tesla, these are definitely on the list. I think they're just such amazingly run companies that are doing actually good for the planet with a really dope mission. And so that's super important. And I think Airbnb, like, I'm getting FOMO as I speak out this as I'm a shareholder. And I just went on a trip to Italy, and now I'm in New York, and I'm traveling, and I love using Airbnb, and like, it just creates incredible experiences. And I feel like you could travel in a way that you would have never been able to before, experiencing the culture, living in someone's home, getting an authentic experience. Like, I love going to Italy, talking to my Italian people, chizing it up with the host, seeing what's good with the local restaurant, like learning from them. Like, I don't know, I just love that. And so it gives me, and I think the way that Airbnb, I've made so many videos about Airbnb, so I don't need to get into it, but this quarter was awesome. And I think the reason also why I sold my Airbnb stock, which is killing me, is COVID. I mean, if COVID is coming back, and it is, and that was a thing in this results, that will dampen this immediate doubling that I thought was going to happen in Airbnb share price. Because let's face it, if the government shuts down and makes us not travel, that's going to hurt Airbnb. And so that was the gist of this report. Incredible quarter. They said it was going to be about flat from the 2 year ago quarter, pre-COVID norms. Instead, it crushed. It was ahead of that. I love the way the management's taking a sandbagging tone to what they're doing. They have a huge amount of cash flow, extremely profitable business, as they book ahead of time in the early part of the year. So that cash flow trend will reverse later in the year. But even so, you're looking at a company with $7.4 billion in cash, rock solid business. Let's just go through the results really quickly. I can tell you that the raw numbers here on hypercharts, hypercharts.co/Airbnb, 83.1 nights and experiences booked, up huge from 28 million in Q2 2020, but that was COVID. You look at revenue, 1.335 billion, up from 334 million. So once again, that's like a triple, but that's the COVID. So you got to go back 2 years to really get a good comp. And that was 1.2 billion. And so 1.2 billion up to 1.335 billion. So really good 2 year growth there. And the gross profit as well, going from 900 million in Q2 2019 up to over 1 billion in Q2 21. So amazing quarter. And then you look at the operating income, They had just a loss of $51 million. And in Q2 in 2019, they had a loss of $100 million. So they cut that loss in half despite just barely growing revenue. So not only are they growing despite still having COVID, but their business is getting more profitable than ever. And this is why I think Airbnb, COVID's actually good for Airbnb in the long run, because it did this G check on them. It was like, okay, you're a startup, you're getting all the hype, like, like you're too fat and lazy. That's what happens to all the companies with too much money that are killing it. And so it's just like Tesla with the Model 3 ramp. Almost dying is going to make you stronger. What doesn't kill you makes you stronger, Kanye West, right? And so Airbnb, I think, is the exact same boat here. And now they're emerging more profitable, more lean, just a better company than ever out of this. And once we get out of COVID, they are just going to hit a home run. This is $1 trillion company. I love what they're doing. Brian Chesky changed the world for the better. And COVID's going to be great for them. But, and if you look at the guidance, of what they said about this quarter or the next quarter, they're going to have a record quarter next quarter, even versus the 2-year, which is 1.64 billion. So they're going to hit above 1.64, 1.8 billion, 2 billion in revenue. But the GBV, gross bookings value, is going to go down. What does that mean? So gross bookings value is the amount of things that get booked, but you don't go on your trip, right? You book it ahead of time. Most people do. I don't, right? I always plan last minute, but most people, apparently humans, they're booking ahead of time. So Airbnb gets higher gross bookings. So the gross bookings are going to go down because COVID's coming back, Delta. But all those bookings that were made in the previous quarter are going to be realized this quarter. So revenue is going to be really strong, but the gross bookings are going to go lower, and that's going to hinder guidance. So, and what they're also saying is like, look, like, we don't know what's going to happen. We're at the whim of, COVID. And so if things get worse or better and governments implement more restrictions, that's going to hurt Airbnb. But I think it's interesting to see that right now there's still like positive cash flow right around that net profitability number, still able to grow. And you think about when I'm in New York right now, it's empty. I was in Rome, it's empty. There's no tourists. I mean, Airbnb is thriving on domestic business right now, despite the international travel being like goose egg. So for them to be putting up these numbers now, like, you're looking at a company like with one hand tied behind its back, still putting up savage numbers. So it's going to be a bumpy few quarters, but I think we will make it out of COVID. I think, and as Brian Chesky said a couple conference calls ago, like, the pent up demand for travel, like, and I feel it myself, my friends, like, we can't wait to go anywhere. Like, I don't even know. I mean, I'm already thinking I just want to live on Airbnb for like the next years of my life, like literally just like travel the world, make videos, live in different cities. And that really hits home for me, because that's what Airbnb is talking about. Like, it's not just about travel, it's about living on Airbnb. People aren't just traveling, they want to literally live for a month in this city, live for a month in that city, longer term stays. And so I think Airbnb, is big and powerful as it seemed, is still in the early days. Love what they're doing, and this quarter was a huge step in the right direction. And it just sucks that, it's not Airbnb's fault that the COVID exists, right? But yeah, so anyway, Airbnb, all said and done, amazing quarter, amazing company, huge fan, major phone might own on the stock. Okay, another thing I wanted to get into, and this is kind of a random one. Ooh, startup of the week. Let's do this. This is gonna be fun. Pipe. So Pipe, the Nasdaq for revenue. I think this is such a cool company, and I'm biased, totally biased, because I'm an investor in this company. Shout out to Neve, Shrug Capital, got in through them. Pipe transforms recurring revenue into upfront capital for growth without debt or dilution. The concept of this, they've created an entirely new category of funding your startup. And so, all these startups that are SaaS companies, like super predictable revenue, I'm going to charge you HyperCharts, right? Love HyperCharts, $10 a month. I pay it, super predictable. And so, but you want to grow, but how do, banks aren't going to give me a loan. I don't want to get VC funding because they're going to take a huge chunk of my company. So this is a huge problem that every sort of recurring revenue startup struggles with, right? And so Pipe is like, wait, we can actually pay you, we can use our numbers and use our magic math to figure out how recurring your revenue is by looking at all your bank statements, and basically pay you up front for that year's worth of customer revenue. And then as that revenue comes in, you pay off this debt. So and that way you don't have to dilute your cap table. It's debt that gets paid off automatically just by your revenue. So, and I love the quote that I talked to Harry about this, and the CEO is this just super dope guy, incredibly forward thinking, hustler, mover and shaker, is just kind of disrupting this whole industry. And he's awesome. And he's like, dude, what's the TAM for revenue? Like, who even knows? Like, how do you even put that in a box, right? And he just had a tweet like yesterday that I wanted to, oh man, I had it pulled up. I don't have internet, but I lost the tweet. It's something like, we did more transactions today than we did in all of 2020 or something, or more was traded on our platform. I mean, the growth of this thing, like, y'all should, not only is this just trading a new category, but from a startup case study perspective, I mean, this launched in I think about a year ago. They publicly launched. The company's maybe 2 years old. They already hit a $2 billion valuation a few months ago. It's probably even higher now. And I invested the round before 2 billion. So I'm hyped on it, honestly, but should have put in more, right? Major FOMO, but nah, but I mean, I've never seen a company grow this fast, like in terms of valuation. Like it's almost shattering records. So from that perspective, it's really interesting to see how much this is blowing up and how quickly, and how much traction they're getting. And I'm actually on the back end of talking to different startups, and through my work with HyperGwap and meeting with startup founders and stuff, I'm actually referring or thinking about referring a ton of companies to Pipe. So that's another reason I'm so bullish on this company and product, is like, half the startups I talk to are like, we hate VCs. We're tired of working with them. You know, no banks get what we're doing. But it's so clear that if we just had a little bit of money to sell the product, we could do that. And so, like Tesla Tequila, for instance, you know, think about if you were the Tesla Tequila company and you wanted to get inventory to sell your Tesla Tequila. It's a huge amount of capital up front, and you know it's going to sell out, but no bank's going to give you a loan for that. How are you going to get financing for that? You don't want to raise a funding round just to dilute for inventory. There's so many different use cases of this, and that's what's so interesting about Pipe, is that it started out as sort of this SaaS company, because SaaS most predictable revenue stream. That's what we're going to securitize and sell. But then even as a month or two ago when I was talking to Harry, sorry, there's a honk. Even a month or two ago, it was already 25% of what was happening on Pipe wasn't SaaS. It was other types of recurring revenue businesses. So they're really trying to expand way beyond just recurring software revenue, and are doing that. And so I think it's when you start thinking like VC management fees is another thing that they got on their platform. I just think there's a lot of cool outside the box ways this could get used, and we're still super early, but this is like one of the hottest, coolest startups I'm following right now. So I kind of want to just put it on your radar, and also say that if you are a startup founder or you work for a startup where you're like, wait, like we have pretty predictable recurring revenue, we love to get paid up front for it, let's use Pipe. Like, hit them up. I'll put the website below. Like, you should sign up. This is super dope. And I think at the minimum, look into this, because this is a crazy category defining new option for startup financing. And I'm so passionate about it, because I think VCs, you know, I'm disrupting VCs with HyperGwap, and I'm sick. VCs are whack. Like, talk to any startup founder. It's a nightmare to raise capital. It's a nightmare to deal with VCs. And so to have another option here that doesn't dilute them, that helps founders, is like really dope and inspiring, and accelerate progress in the entire startup ecosystem. On the flip side, now this is a new institutional class of assets people can invest in. So you have all these big companies that are like, wait, we can invest in this. So, and the way it works is like, they'll pool all this revenue, pool it, anonymize it, and then sell it out in different risk tranches, I believe. And so one of the fastest growing fintech startups in the world, creating an entirely new category of startup financing, run by a savage founder. You should go check it out. Super, super dope. Interesting story to follow in fintech. Okay, next piece of news I wanted to say, Traeger Grills. This is just a fun one. Like, there's so many kind of fun facts within this one. First of all, the CEO is Jeremy Andrus, which is a dope guy. Shout out to him, because he was the CEO of Skull Candy, which was like one of the first companies I invested in when I was like 18, and I was writing articles on Seeking Alpha. And I actually got a meeting with him in New York at the stock exchange when I was like a freshman at NYU. And he met up with me, and we like worked on an article, because I was writing about Skull Candy at the time, and I was a shareholder. Like, I don't know, Skull Candy, it was whatever. Like, I mean, they had cool headphones at the time, but it didn't really work out as what I was expecting, but that's business, you know. But he was awesome. I loved him, and I don't know. So I kind of always had a soft spot in my heart for like the CEO who was like down to meet with me and help, and just seemed really smart and cool. And then he eventually moved on to Traeger Grills, right? Which is like the company that Joe Rogan made famous. Shout out to my cousin Josh too, who loves his Traeger, like, and my homie Joe, I think, has a Traeger. Like, everybody who has a Traeger that loves it, like this grill where you put like this artisanal wood in to smoke your meats the way you want. And it's an amazing product. Like, people can't shut up about it, kind of like Tesla. And so they IPO'd with the SPAC. So one good thing about this SPAC boom is it's reduced the friction on these companies to go public. Like, yes, you had just shitty scam companies like Nikola. Oh my God, let me get to the Nikola contract in a minute. But who are able to SPAC and raise money. They're total frauds that are going to scam investors, even like Lucid. Whoops, wasn't supposed to say that. But I'm actually going to try and go to the Lucid store while I'm in New York, see if it's open. If you know if it's open, leave it in the comments below. But Traeger, dope. There's actually a bunch of dope little companies that, because of this SPAC boom and because of this new, you know, sort of accelerated progress on just how easy it is to IPO, are able to IPO. And so love the progress there. And one of them is Traeger, this grill company. And I was reading their S1, which is fascinating. And I think they're only about a $3 billion company. And I was looking at the financials. I was like, bro, these guys are crushing it. 2020, $554 million in revenue, $235 million in gross profit, $60 million in operating income, like super profitable, over 10%, 11%, 12% operating margins. They're as profitable as Tesla was last quarter. I mean, and they're only trading at what, like 7 times trailing revenue? you know, and then earnings this year, maybe 30 times earnings if they do 100 million. Like, I was like, damn, this is actually a pretty reasonable valuation for a company that customers love, where the CEO is super dope. And you look about the TAM, the total addressable market, that's the one thing I'm kind of, how big can a barbecue company get, right? Like, they say that only 2% of households in the US that could have barbecues have Traegers, so they're only 2% penetrated in the US, but I'm not convinced of that. They say that they're only 3% penetrated for everybody who has a grill, but I think it's a little too bougie. Like, you have a small apartment, you want a smaller grill, you got to deal with the wood pellets thing. It's kind of for aficionados, but maybe they're going to commercialize and bring down this technology, you know, artisanal grilling for the masses, you know, hyper-changing that. Yeah, and I do think this kind of goes in line with the way that I think about the food industry as well, because, you know, shout out to all my people who are reducitarians like myself, or like, how can we reduce the carbon footprint of what we eat? Like, golly, grilling burgers isn't helping us. Like, but I think it, in some ways, the culture that Traeger promotes of food, of caring about your food, making it artisanal, enjoying it. You're not going to buy a crappy piece of meat and put it in a Traeger. Like, you don't want to buy the factory farm shitty stuff. You want to buy a good pasture-raised, great farm cow or brisket or whatever to put in your Traeger. That's supporting the good part of the food ecosystem. And it's not all or none. Like, we're not going to stop eating meat altogether. I think what needs to happen is we need to stop all factory farming. We're going to have, you know, 95% reduction in the amount of meat in the world. But the meat that does exist will be cooked way more artisanally and will be way more enjoyed and will be taxed extremely higher. And that just is the reality. It will turn into extreme luxury good if governments can get their shit together and tax the negative externalities of that industry. And so that is what it is. And that's another reason, I don't know, am I going to buy Traeger stock? No, because it's not that exciting. It's not changing the world in the way I want. And I do think that this reduction of meat consumption overall could hurt them. But then it's like, well, yo, you seen that grilled cauliflower steak trend, the grilled watermelon trend? Are people going to be using artisanal wood pellets to grill their watermelon steaks? Maybe. But even so, I don't know. I just thought this was a cool one to mention because I love this little company. And when I looked at the financials, I was like, damn, like, they're actually killing it with the financials, like making money, like growing like crazy, like people love the product. Like, this is a really cool one to follow and just an interesting business case study that they're public. Like, now that they're public, we can all see the financials, we can listen to the conference calls. So I'm a big fan of that. Oh, okay. So last thing I guess I'll rant about today is the market caps. One thing I thought about Traeger, and I was trying to do their homework on them, right? Where's the share count? Like, I found the 3 billion thing because like Google Finance said the market cap was 3 billion. Do I know if that's right? Nope. So this is like the biggest, and y'all are watching HyperChange, so you probably know the difference, but like, how many share, like, everyone thinks like, oh, Airbnb is 150 per share, so it's 150. That's more expensive than, you know, Tesla's 700. So that's more, you know, it's like, it's just the dumbest misconception in finance is market capitalization versus share count. Like, how much is the company worth is amount of shares times price per share. It's not like every company has 1 million shares. It's a randomized number. Some company has 1 million shares, some company has 1 billion shares. You know, you don't know. So you have to adjust the share price for the amount of shares. I know this sounds simple, but like, it just boggles my mind that this is not a status quo. And I think this is the biggest friction in mainstream people understanding finance. And so this is something I've been thinking about. Maybe you can help me out, is how do we solve this problem? And HyperCharts, I think, shout out to Mo, and what we're doing with HyperCharts is huge because that's the first thing we put on every company's page is the price per share and market cap, showing you what is the company worth. The financials, all relative to, you know, the overall market cap. Nothing's in price per share. Price per share is the most dumbest bullshit number I've ever heard of on the planet. If you watch CNBC, they're going to tell you to care about it. That's another reason why CNBC is just morons. But I think this is, I don't know, I can't come down, like, the amount of people who are like really smart and are getting into investing but still cannot wrap their head around the market capitalization versus share price thing is just mind-blowing. So I don't even know why I'm saying that, but that's just something I've been thinking a lot about. And I think the onus is on the fintech companies of tomorrow to make this easier, and as well as these companies on your investor relations page to put your share count. Here's how many shares, here's our price, here's how many shares we have, bam, here's our revenue. Like, why is that so hard to get? And so that's why we created HyperCharts to do that and solve that problem. But anyway, that's, yeah, maybe not a great place to end it, but ooh, okay, actually, I'll end it with this like savage little moonshot that one of my subscribers sent me. I'm forgetting his name right now, but shout out to him because this was so dope. I'm gonna make a whole moonshot about it right now. I'm just gonna give you a little preview just because, you know, we're scheming right here. Imagine what's the next thing with Tesla Vision? How do we get the humanoid robots? How do we solve a real big problem with the Tesla AI shit, right? What if you had, you know, what are all these sort of mundane tasks and jobs that are being automated, that we can automate one step at a time? How do we automate them? Like, you know, I don't know, like, you're moving boxes, you're shipping stuff, you're driving a truck, you're doing this, you're doing that. Like, maybe even being a waiter or waitress or bartender. How do we start getting robots to learn how to do those things? And you might be like, wait, you're putting people out of business. Like you're stopping jobs. Like, first of all, nobody wants to work. I don't know if you've noticed, but like every restaurant in New York is short staffed. Nobody wants to work. This is a shortage that's coming. The biggest problem we might face if AI doesn't kill us, population collapse, right? So it's like, damn, like how are we going to solve this? Well, we need to have fleets of humanoid robots doing these tasks. Like, we're so lazy. We just want to press a button and get our burger. Like, if we want to keep doing that, like, humans don't want to walk and give us our burger anymore. Like, we need to have robots doing that. And so I just think there's like Japan, like there's all these old people and there's not enough young people to take care of them. They need robots. And so that's why they're pushing forward for it. So how do we solve this problem? What if you had like glasses with Tesla vision, snap spectacles idea here? What if you had glasses with cameras, Tesla vision, right? And you had like this bodysuit, maybe you just start with gloves that have feedback and sensors. And so when you do your job, you know, you're picking up boxes, you're moving that, you're doing that, you're training the AI to like basically learn how to do your job. And you might be like, wait, why would people want to train the AI to learn how to do your job? Like, oh, I'm a bartender, I'm gonna make this drink. Like all of a sudden the AI is showing you how to do that. Or you're at a cafe and it's like, oh, you know, make the cappuccino, put the button here, press this, do that, move it here, give it to the person, call their name. Like maybe they have sound built into these glasses too. I don't know. This is a crazy Moonshot idea I haven't fully fleshed out, and I want to do an episode on it, but you get what I'm saying. Like you could, by putting these sensors before the full robot on the humans doing the job, we could train the AI and the robots to figure out how to do these jobs by not this like, you know, sort of like, it's kind of like a different idea than like starting from scratch and just having the robot do everything. It's like having the human train the robot, which I think is kind of like what Tesla's doing with driving. And so I just think this is such a powerful idea. And even beyond that, shout out to this HyperChanger. This idea was insane. I'm going to put his Twitter handle below, or if he lets me, but it was that you could get like a dividend. So and you're like, okay, well, I don't want to train the AI, it's going to put me out of business. Wait, you're training the AI and there's a smart contract by the amount of data you contribute, by the amount of edge cases you solve, you are getting rights to the dividends from that robot fleet in the future. It's like a form of UBI that you're earning by training the robots to do your job. So if I train the robots to deliver all these Amazon packages, because I'm an Amazon package deliverer and I do the best job with the best edge cases, I'm gonna get a bunch of these tokens that will then create revenue because the robots will be doing the work and give a portion of that revenue to me for helping to train them so I can have a retirement once the robot takes over. This idea, it blew my mind. It was so dope. And so think about, I don't know, I'm just gonna leave y'all with that little end scheme. I should start doing like a crazy Moonshot scheme like that at the end of every video. So yeah, if you're also another Patreon member who has a scheme like that, please let me know. And also Patreon members, hit me up with an email, galileorussell@gmail.com. Tell me your name and that you're a Patreon member. And if you have something that you want me to cover, and I'll try to do it in the next week's episode, or like a scheme sesh or anything like that. Yeah, because this was just such a dope idea. I loved it. This is HyperChange. See y'all next time. Have an amazing day. Ciao.